I've fortunately have not personally lost in an audit yet. My approach in audits is to try to get the information to the auditor as quickly as possible and be helpful. Now, sometimes, of course, you use the strategy that the auditor is probably overloaded. So I can't give away the whole strategy.
All right, we're back here with Well Mentality. Leon Aloya here with Karl Jackson, tax attorney, Houston, Texas. I'm gonna let him give a little brief of his background, where he's been, how he got here, schooling, hometown, yeah, the whole nine. Karl.
Okay. Yeah, so I am a tax attorney. I went to the University of Houston Law Center where I got my JD and my tax LM. I'm an accounting undergraduate, so it just made sense to go into tax. And I started my career off at a large accounting firm or a large oil and gas company here in their accounting department. And before I went to law school, and then once I finished law school, I started at a great firm here that I got a ton of good experience. It's one of the big four accounting firms in their M&A tax practice. And then I moved on to a small boutique law firm that serviced like the majority of their client bases, high net worth individuals and entrepreneurs, and worked with a larger firm here in Houston. Got a lot of great experience there, and yeah, so now I'm ready to share my experience. I think overall, I have I've been a bar attorney for 5 years. And I say a tax practitioner for 12 years.
Gotcha.
Yeah, so before I even moved here, I was back in St. Louis doing tax returns. Yeah. Just small tax returns for individuals.
Right.
So that's where I really got my true start.
And in that phase, was there already an element of strategy? And I'll come with that term. You're going to hear me ask it over and over again, or repeat it over and over again. Strategy, because a lot of what I hear, and the reason why I think you're so important to our audience, at Well Mentality, but also your audience, even broader, is how the strategy itself can help the bottom line know differently, maybe even with a bigger bang than a lot of other items, from payroll to utilities to other things that you might have in your line item. And you think about how can I optimize and strategize on that tax element, can probably have a bigger bang for your buck. So I'm gonna keep on repeating it, because I don't think a lot of people, unless you're probably already in that bucket where you've seen the impact, I don't think a lot of people really realize that. So I'm gonna keep on touching that. So now, in terms of strategy, even back when you're doing called the base tax return as an accountant, was there already an element of strategy that you could feel inside of you of, why is this person doing that? Oh, I would have said it like this if I was them, or did you feel yourself kind of having that internal?
Yeah, I think once you get to the compliance component, and it really depends on the I think every tax preparer is a strategist.
Yeah.
Unfortunately, it's with respect to the compliance itself and how to present the information that's already there on the tax return, in the best light for the taxpayer, within reason. So, and not in terms of strategizing on how the numbers are generated or how they're classified, because that's, we have to do that ahead of time. But I still think there's a level of strategy, because every taxpayer wants to either have pay less tax or have a larger tax credit.
Right.
And oftentimes, where the numbers go on the tax return make a difference.
Right.
So as a tax preparer and doing compliance, I think that's where you think about the most. Versus as a tax attorney and a tax strategist, I want to talk to my clients before the turn of the year, before the numbers are locked in, so then we can, really help the tax preparer when it's compliance time.
Gotcha.
Yeah.
Gotcha. Well, look, I got 30 questions here that I want to go through. Not all 30, but we'll pick up, call a random 7 or 8 or so, just to give a little flavor of some of your background. And and hope that this educates the audience and leads to further discussion.
All right, let's go.
So let's see here. First, can you describe a complex tax case you've handled and how you resolved it?
Okay. You asked me this earlier, so I'm going to choose a different case because that was a long story. The first one has to do with complex tax rules in the partnership context.
I think that,
Yeah.
I think that's a good. I think that's a good item. The
Well,
partnership.
I'll just try to make a long story short. Yeah, so using like a complex area of tax law is partnership formation transactions, and sometimes partnership formation transactions are used by the large corporations. Uh, like here in Houston, a lot of oil and gas companies have tons of partnerships below the C corp. So they have a lot of they have a lot of partnerships below the C corps, and they use the partnership tax rules to either pull cash out of partnerships or minimize their tax burden. So I think I have a client that, that had an issue where she had some cash trapped in an entity, and we utilized the partnership tax rules, specifically the exceptions to the Sky Cell rules, to transfer assets from her. There was a related corporation that had assets, and we formed a partnership, and then we were able to pull some cash out for my client in that transaction based on the exceptions to the disguise sale rules.
Yeah.
I think we can really have a whole podcast about the
Right, just that
transaction.
alone.
Yeah, because there was actually some issues that there are like a lot of hurdles to jump over to make sure that you tick and tie all the requirements of the rules and to hit every exception to the sky sale rules. But this particular one was the return of pre-formation capex exception to the sky sale rules that allows a taxpayer to contribute assets to a partnership and then receive cash. So generally, that will be a potentially taxable transaction. However, when you turn off the disguise sale rules, you can contribute assets to a partnership and pull cash out on a tax-free basis.
All right. Based on your basis in the item.
Yeah, based on your basis in the item, based on how long you've held the item, based on the fair market value of the item. I mean, you have to have had the property for less than 2 years, 24 months. The fair market value of the asset has to not exceed 125% of the basis. So they don't want you to have a heavily appreciated asset. They want you to have an asset that you recently bought. The fair market value and basis are virtually similar. So at the end of the day, like if you think about that trend, the reason why they turned it off is like if you are transferring if you bought something yesterday and you transfer it to a partnership and they give you exactly what you paid for it back, you shouldn't have a taxable transaction.
Right.
Yeah.
It does make sense.
Yeah, it does. So however, if you hold it longer than 24 months and you're outside the scope of the exception, then the disguise sale rules kick in because generally people don't enter into partnership transactions to just get their money back. So it's really to really do a sale, but they want to use the partnership rules to avoid taxation.
Right.
That historically, that's why Congress adopted the disguise sale rules.
No, that makes sense. Let's see here. Let's dive into this next one on the various changes. So how do you stay updated with the constant changes in tax laws and regulations and presidents and vote? It seems like it's forever changing. How do you stay fresh on that?
Yeah, CLEs, any types of law firm updates, like specifically with this new tax package that's coming out. The House Ways and Means Committee was putting out their notes, and we have tax practitioners that go through and read that information and disseminate it to us, and just keeping up with the committee notes.
Yeah.
And of course, you got tax notes. You have got B&A portfolio, so you got a ton of different options, to keep you informed on the changes. Yeah. So then they put out the draft, tax package, so you can go through and read it yourself, and before it's even enacted as law,
Yeah.
to prepare.
Got you. So they got, I don't call it the cliff notes, but the hey, freshen up on these is coming. So that way you're already kind of greasing the skids with the client and thinking that strategy.
Yeah, so that's really important. So with respect to this new tax package that came out, Congress is changing the statutes of limitations for some tax credits that are very valuable to some corps out there, which is the statute of limitations was like for the year 2020 tax credit, because it's something that you can claim for your 2020 tax return, and also 2021. The statute of limitations for the 2020 tax return was April 15th, 2024, and the 2021 tax return, April 15th, 2025.
Yeah.
However, in this new tax package, they want to shorten the statute of limitations and bring it to January 31st of 2024. So if you aren't paying attention, even though Congress hasn't enacted a bill, once they do, it's going to have a retroactive application.
Right.
So there are a lot of people, a lot of corporations, business owners that are applying for the credit right now,
Right.
that may not get it because they, who's reading the law like that? They believe,
retroactively get
exactly.
enacted, yeah.
And it's not law right now, but Congress is really just taking money from one bucket, from the CARES Act, to fund this new tax bucket, and we don't want to get into that, but get into what I believe. They're claiming that they're balancing the budget by robbing Peter to pay Paul. I guess that's fine. But it definitely it's a challenge for tax practitioners to really call their clients and say, hey, we thought we had more time. We don't. We really need to get this done before this potential deadline.
Right.
Yeah.
Exactly.
Yeah.
But like I said, if you're not fresh on it, you can miss the boat. Let's see here. What strategies do you use when researching for a case involving an unfamiliar tax issue?
If it's an unfamiliar tax issue, of course you have to, Google.
Right.
You got to Google
That's
first.
Right. I just had a conversation with a lawyer last night, and they were talking about the need to be up with technology, and the argument that he was stating was something to the tune of, if you're representing your client correctly and you're not using the 2024 version of technology, then you're not necessarily serving your client to your best ability. And it can be deemed, like if you just didn't do a Google search, an easy Google search, you could have got some background information that could have better protected your client or better served your client, but yet you didn't. It's almost like a lack of care and responsibility that your client is paying for, as they think they are.
Yeah, because you got to be able to formulate the question, I think, in order to understand the tax issue. So you got to start with Google, and then they have other, like in the tax realm, we have B&A portfolios, which are constantly updated by practitioners. You have tax notes. You have Westlaw. There's a ton of. You have Lexis tax. There's which is virtually like all of this it could be considered AI because it's really how you search through it.
Right.
It's not going to answer it's going to send you to where you need to go. You definitely have to dig through, and it'll send you to the code and related authorities.
Right.
But these search tools that are available right now in the tax realm, at least, are very powerful. And I know in the litigation realm, if you understand how to formulate the question, then you can get close to the answer to where you can drive down. I don't believe that ChatGPT is there yet, or any of that AI, because one is, I don't think it's pulling from 2024.
At least ChatGPT itself, I think they still now maybe I think it's year in 22 is what they announced. But you're right, like it's still not necessarily relevant. There is, I forgot the terminology, but it's called it information loading, where people are uploading a lot of information to these bots and letting them learn. But to your point, you still have to have a knowledgeable ear, eye, and understanding of what you're working on to be able to comb out what's not necessarily fact or what might be, it found it on the internet, so the AI bot legitly found it, but that was a fake case. That was a fiction item. It was, it was a book. It was like how does, who can pull that out? It has to be somebody with that level of expertise, not just Joe Blow like me, being a weekend warrior on the laptop, trying to write up a contract, right? So.
Yeah, I agree. Got to ask the expert.
Right.
Ask the expert because even I have to lean on my mentors
Right.
on complex items.
Right. No, that's key. Let's see here. Can you share an instance where you had to defend a client against an IRS audit? What was the outcome?
Yeah. I mean, I've fortunately have not personally lost in an audit yet, which is great. I guess it just depends on what your definition of losing is, but I have. So my approach in audits is to try to get the information to the auditor as quickly as possible and be helpful. Now, sometimes, of course, you use the strategy that the auditor is probably overloaded, so you can give the auditor. So you, I can't give away the whole strategy, but I try to give the auditor all the information I can as quickly as possible and build a rapport with the auditor and virtually build, like to the point where we've established trust, gotten everything that I can. They understand that I'm knowledgeable about the situation,
right,
and put the best argument forward. And there's generally no BS. So if I don't go and if I'm not BSing the examiner or the auditor, or if we're in appeals, if they don't feel like I'm BSing them and then they understand that I know what I'm talking about, we'll generally have good results. And I've been on several audits to where I feel like if it wasn't inappropriate, these people could be my friends, because after a while we're really talking about how their wives doing, like what they have going on for the day, or how like things going on in life. That's where we get to. So
it's humans talking to humans.
Yeah, and I think just generally being a nice person can get you a long way.
Right. It's funny how that works.
Yeah, because they're extremely busy. They want to get to the taxpayer, that are truly like breaking the law.
Yeah.
Truly tax. Tax evading. I don't want to say tax criminals. That's what I was about to say. But tax evading, and they don't want to get to someone who may have put the number in the wrong spot, or didn't communicate the substantiation properly, or genuinely may have made a mistake, and that's all it is.
Right.
So we want to avoid. So the issue may be, okay, we like I've been in a position where it's like, okay, we're gonna pay the tax. Obviously, if I feel like we're gonna pay the tax, my approach is to say, hey, look, it was messed up, but there's levels of opinion on whether, like, when you take a position, if you have some sound reasoning as to why you took that position, you can avoid penalties.
Right, you have a lot of leeway.
Yeah, so sometimes the clients may not like the taxes, but I tell them, you gotta pay taxes.
Right.
You can't make money and not pay tax. So now if there's a position that we had and it was aggressive, okay, they're gonna disallow the deduction, or they're going to include the income. You have to pay the tax. That's fine, and then you have to pay the penalty.
Right.
Yeah. So, or we'll try to help you not pay the penalty.
Right.
Yeah.
No, that's
Yeah.
that's good stuff. Yeah, fighting and talking to the IRS is something that's not making people comfortable on a normal basis. So, definitely them working through you and your clients working through you and getting that. That assistance.
I'm undefeated against the IRS, so
there you go.
At least in my mind.
No, and at the end of the day, if your client's saying that's a win, that's a win.
Yeah.
Like you said, like it's not you pay zero tax. No, you have to pay tax if you make money.
Yeah.
So, but the reasonable amount, the right amount, and avoiding penalties. But staying aggressive.
Undefeated doesn't mean that I'm going to make you pay no tax.
Right, exactly.
Undefeated means that you didn't pay the 75% penalty that they were going to assess on you, or you didn't pay the 20% penalty and plus the interest. And it's sometimes that's a win, because I just explained to the client, so, like, some of the times it's really sitting the client down and just saying, do you owe that money?
Right.
and getting that in their mind.
Yeah.
They digesting that, and like, now let's work on the penalties.
Exactly.
I can help you there.
Right.
Yeah.
No, that's good. That's good. Let's see here. How do you approach a case where a client has been non-compliant with tax laws?
Well, then
guess kinda
we get them
building on that.
compliant. Like, I had one client that didn't file taxes for 10 years, and I hope he's not watching this, but I'm not going to name him. So he didn't file his tax returns for 10 years. So I engaged one of my friends who's a tax preparer, a CPA, and we got him on the case. He did all the back tax returns. So that's the one thing you got to do. You got to do all those back tax returns. So you got to get the bank account statements, because he probably didn't have books.
Right.
So you got to generate tax returns based on those. If you can even get the
If you
bank
can get 'em.
statements from that far,
That's right.
far back. Maybe 10 years. I think it was like 7 or 8 years. But that's still
Yeah, a long
that's still
time.
crazy.
Right. And I guess from the IRS, and I don't know if I mean, you think like they have to pick up something somewhere saying, look, this person hasn't filed yet. Ding, ding, ding. So for them to go that long and the person still be able to, I call it, live life like normal, is that just a matter of they know like there's not really a whole lot of juice there? So why really go chase after it? Maybe he might not even know. I don't know. Or is it more of a no? They just can't. They just can't detect. Or I mean, there are people that happen to go 8 to 10 years straight, and
Yeah, it's a self-reporting system. So for him specifically, I got to commend him, because we pulled the transcripts. There were no 1099s filed. So the IRS had no clue how much money this man made, but he still reported all of his income.
okay,
And even though, so that's the issue. If you have 1099s and W-2s being submitted to the IRS,
right,
it's easy for the IRS to generate a tax return for you. They'll they'll generate a tax
Right.
return for you and send you your tax bill.
Right.
But if they don't have a W-2 or 1099 sent to them,
right.
they have nothing to compute.
That's right. Yeah.
So the IRS is just on that self-reporting system. It's hard for them to really go after every taxpayer in the entire country, every 150 million taxpayers. That's
Right.
a lot.
It's a lot.
Yeah,
It's a
they
lot.
don't have, they don't, like, I guess that's a problem, because a lot of people don't pay their fair share of taxes. But it's also like a strategy, if you're a taxpayer, to play on the fact that there's more taxpayers than actual IRS agents.
Right. Right.
So you just playing
Like
the
so
percentages.
many numbers. Yeah. Like
Yeah,
exactly. Stay with that reasonable band, and you're probably going to be.
We might have to cut
decent.
that out.
Okay.
I don't play the percentages.
What's your process for preparing and reviewing tax returns for businesses and individuals?
Yeah, I don't prepare them, but when I review them, of course, I mean, I want to look at gross income. I take a look at I really just focus on the expenses. I make sure the gross income's totally there.
Mm-hmm.
Look at the taxpayers' expenses. And when I look at the tax return, I try to look at, and that's why I always encourage my clients, let me see your tax returns, because I can see if the tax preparer did it correctly, and also whether the tax preparer even thought about, the tax preparer could have done it correctly, but there's also some strategy in where can we put numbers,
Right.
What could we have done? So maybe it's just from a perspective of, okay, yeah, the numbers are locked in, but let's
what
see,
could you
where do
have
we
done?
put
Yeah.
these numbers at next year? That's why we want to meet before the turn of the year,
Right.
so that we can make moves before the end of the year.
Yep. How those adjustments, and to your point.
Yeah.
I mean, understanding that before it's too late allows you to take advantage of either reducing costs or extracting other incremental value.
Yeah, I have one client, and this is a good example. He is so good. He's good at running his team. He has a bookkeeper, he has a CPA, and we meet we meet in October, November, December, right? And from these meetings, which if you look at the total cost of the strategy, let's say it's 10 hours of my time, and from that meeting, we generated a tax strategy that saved him, that pushed like $500,000 of tax into the next period, and then once it was time for him to actually pay the tax, he only had to pay $150K. So from a $5,000 strategy,
Right.
he saved $350,000 of taxes.
Right.
And that's because he was able to meet with me. Now, he even got audited on that issue.
Yeah.
And I was able, because we were planned for it,
Right.
and I was able to draft a proper substantiation for that transaction. Then once in the audit, we were successful.
There you go.
Yeah, it was a review. They said we got the substantiation, sent them everything immediately. The IRS on the first notice,
Right.
we have an issue. Can you please explain to us what this number is? Of course. Here's the substantiation. Day one, sent them over the information, and they saw that this was not something that we had generated like just because we did an audit. We thought about this strategy.
We ran the math.
I think that's one of the most successful strategies outside the disguise sell transactions.
Right.
Because we talk.
Yeah, and that's what it is. That communication.
Yeah, and I have clients that are under audit and they made purchases, large purchases, and without the proper substantiation ahead of time, and it's hard for the IRS to digest it.
Right.
Because
I'm already looking at it.
In the middle of the audit, I can't produce documents.
Right.
So if there's supposed to be loan agreements, if there's supposed to be asset purchase agreements, or whatever, I can't generate those for the client in the midst of the audits.
Right.
So I ask them to produce that. If they say they don't have it, I say, are you sure you don't have it? If they say yes, and I'm say, okay, fine, we'll just work with that.
Right.
But like if I say, are you sure? I mean, I can't just be like,
Yeah.
I have to. I mean, I play the game fairly. I try not to breach any boundaries of professionalism in my practice. So I take what the client has and I do the best with that. And if we were able to discuss it before this audit and before they did the transaction, most of my clients wouldn't have these headaches in their audits.
Right.
Yeah.
There you go.
Yeah.
Well, let's ask about some of your expertise and whatnot. International law. A lot of people doing business overseas and whatnot, or offshoring and bringing dollars back. What's your experience with international law and specifically how it applies to your U.S. tax?
Yeah, for the most part, it's international reporting of foreign bank accounts or interests in foreign entities, making sure those are reported to FinCEN and probably reported on the tax return, because the penalties for that is steep. If you have an international bank account and you're a U.S. person, even if you're a foreign citizen that has U.S. residency, you have to report your foreign bank accounts. And the penalty for non-reporting, it's really a bank account that had a balance of at least $10,000 in it. Okay. If you don't report that, the penalty is like $10,000 per instance.
So I'm gonna take your account.
Yeah. I mean, there was recently someone had $50,000 and their penalty was like $1.5 million.
Right.
It's
a non-compute.
Yeah. The IRS has these very harsh rules.
They don't like that. That's basically what that boils down to.
No, they want people to report their foreign bank accounts because they want to make sure that it's such a harsh penalty because they know that's how people move money around and avoid taxation. So it's kind of like it's more than a slap on the wrist because they want to make sure that people report. And then there's programs you can get into if you don't report your income. The IRS understands sometimes there are mistakes that let you voluntarily disclose. So this is really going to be important when it comes to cryptocurrency.
Okay.
So what's a foreign bank account?
Right.
What's a foreign account? Cryptocurrency. We already have a cryptocurrency reporting rules. Well, there are smart people out there. What if the cryptocurrency isn't owned directly by you, but it's your cryptocurrency?
Right.
What if you own it in a foreign country? What if it's custodied by a foreign institution, but it's your crypto? It's not here in the U.S. So you think you buying and selling it and avoiding U.S. tax consequences. Well, the U.S. wants you to report that in certain circumstances, and they're going to have the same penalties.
Right.
Yeah. So it's going to be harder to trace, but they're trying to implement rules surrounding cryptocurrency right now.
Right. It has to come about. I mean, and I get it. Like it's going there.